Good day, all. Ira Epstein with your holiday edition of your agriculture update for this Thursday, the 23rd of May, 2019, just after 4:30 p.m. I say the holiday edition because I'm playing hooky tomorrow. I'm going to take off a couple of days. That gives me Friday right through Monday with the Memorial Day, and it's like a mini vacation for me. I can't wait. But in any case, I want to remind everybody that as we come to the end of this video, and we're going to do the weekly charts instead of the dailies right now, at the end, I'm offering a special for the Memorial Day period on my charting course. So you'll see how that all works. But let's discuss what went on. Big news conference today. The USDA is getting monies now to pay farmers for the damage being done by the trade war, up to $16 billion. How it's working out is different than the last time. The president's looking at county damage, not individual farm damage. I don't have all the details. I have a lot of them, and I write about it in my research report tonight. But do I have them all? Not quite yet. They're trying not to influence the farmers on making planning decisions, but remember, the prevent programs kick in right now. Is that going to add more soybeans to a mix of already a monstrous amount of crop we have? Don't know. Weather patterns haven't yet given up on anything, so there's a lot to talk about. Dollar down a little bit, stock market down, war of words between Nancy Pelosi and, of course, President Trump. One saying the other needs intervention. That's Nancy saying it to the president, and the president thinks she lost her mind. Woo, very much fun. We still don't have a trade deal with Canada or Mexico because the president did say he's not sure she understands it. She needs a couple of weeks to go through it. In any case, you laugh at this. I mean, you couldn't make all this up. The monthly area chart of closes, we're still under pressure. And for the month ending today on Thursday, we are down 20 cents on the month. When I come to the weekly charts, you can see that we had a gap, even on the weekly bar. You see that? The market came back, filled the gap, and is basically stalled out, at least going into Friday. I don't know what the weekend will hold, but we'll see. When I look at the swing lines, I have a pattern of lower highs, lower lows. That is definitive in a bear camp on that pattern. The resistance is back up if the market should rally into this 880 area, and that's still well under the last swing line high of 907. Am I saying you're going there? That's a 60-cent rally. I'm not seeing anything right now that should put it there. I don't know. I just see the market as what? The trend down, the bias down, that's a resistance point. The support points were hit. You stayed a couple of weeks underneath the lower Bollinger Band. You popped over it, not this week, just last week, and this week you followed through again. And you can see that right here. You can see how you were under it, you came back in. Remember the purpose of a Bollinger Band. You will trade within that band 95% of the time. When it steps out, my rule of thumb, whether it's a daily chart or a weekly, and it's only a rule of thumb, that I subtract each one of these as a percentage of that 5%, giving me an idea of what the percentages are, at least mentally, that the market will move back on a correction into the right side of the band. And it happened there, and you're still in that. That doesn't mean that this sideways action has exhausted itself to the downside. In fact, if the farmers are going to plant more soybeans because they're getting X amount of dollars because of damage done, wow. Farmers like to plant, remember that. So we'll see what goes on. In terms of momentum, it tried to turn up, and I could argue a little bit that it's in that turn because the red line is over the blue, and it wasn't that way before. So I'll call the momentum sort of sideways here, a little bit of a kick to it to the upside, the bias down, the trend down, hit some targets, moving to the right-hand side. In the meal market, momentum is pointing up. The market had been underneath, and you can see it here, the lower Bollinger Bands. Last week, the market rallied, made a run, got as high as 304.90, hit that 18-week average of closes, stalled itself out, and all you've done is had an inside week so far. Again, beans and meal, the question is, what is the farmer going to do now that he knows he's getting an aid package? I don't know how they're going to divide it up within the counties yet. In the soybean oil, I still see momentum down. I see lower highs, lower lows, bias down. this market, if it stalls here, could easily get back, if it decides, to that lower Bollinger Band. If it should rally from here tomorrow and just keep going up, I see resistance then at 28.84. In the corn market, you went from this pattern. You were riding the lower Bollinger Band, and then the weather. This became a weather market, and the farmers couldn't get into the crops. So you go from the lower band. If you keep going, I'm going to look for the upper band. That's where you got this week. Now on pullbacks, I'd be looking for support to see what happens between 367 and 3/4, 364 and a half. Momentum is up in the wheat. You negated the downtrend. You had been up until this pattern, having lower highs, lower lows. You had been under that Bollinger Band, moved to the right-hand side, and then rallied to that 18-week moving average where prices stalled out. That puts the 100-week as the next resistance. The market got through that, and if you look at it, you're right now at 470. That 100-week is 476 3/4, and you're pulling back towards that 18-week average. I don't see this market in a trend right now. I see this as pretty neutral. In the cocoa market on the weekly chart, momentum is still bullish. The pattern is still one of higher lows, higher highs. A potential upside target could be the upper Bollinger Band at 24.71, and I'd be watching carefully this 22.91. If the market let go from here and got under that, it could negate the uptrend. Support coming in around 22.93. In the sugar market, I still see a bear market at work here. Lower highs, lower lows, pushing out of the sideways action that the Bollinger Band was going in. It's now pushing on the market to the downside, and momentum is pointing down. In the coffee market, while the daily charts had a nice run to the upside, first time they actually got to an upper Bollinger Band, and I showed that yesterday, you can see on the weekly chart with the current pattern we have higher lows, and with the high this week so far at 9,400, we took out that last high. The problem is, again, you've got to watch this 18-week average. The market needs to close over it to get the trend going up. You already have the momentum, so you have the bias down. What do I mean by that? When you close under the 18-week average, I determined that that's downside bias. Over it is upside bias. It's a filter on the swing line. So while the swing line says the trend is up, the bias negates the two, and you've got to wait and see which wins out. In the cotton market, still a bear market. Lower highs, lower lows. You had been under the Bollinger Band for a week or so. Now you've pulled to the right-hand side, but still no change in the overall picture. The cattle market, there's a cattle on feed report coming out tomorrow. The market will probably wait to see what that does. But going into the report, lower highs, lower lows. We have a heck of a lot of beef, and the early projections are for even more to be placed into the feedlots and so on. So the early projections look fairly bearish. Will the market be able to stay under the lower Bollinger Band is about the only question I have in my mind. In the hog market, we are still with a market that's got higher lows and higher highs. And yes, I did see that China, there were some purchases of hogs that actually went through that I noticed today. So as bad as they don't want to deal with us, you got to search all over the world, be it the EU, South America, for this pork. One way or the other, it's got to get to their people. So you put it together and you come to this, my charting course. A couple of times a year, it's rare, I decide to lower the price on the charting course. For the Memorial Day period, I've done it. Normally this course, by the way, is $169.95. And it's going to have 54 videos in it with charting software. If you've not had access to my research, it will include that. It's going to include a lot. It's going to include, like I carry around my phone with everything in it. You're going to learn swing lines, moving averages, slow stochastics, Bollinger Bands, and something we don't discuss in this general area, window envelopes, which is a profit-taking tool only. It's not anything but that, and I explain why it is and where you're at. So as I said, it's 54 videos. You see what I do, use our charting software, and the data will go back to that point in time. You do as I do. Then you're going to get instant access to all my research, including the morning videos and all, if you haven't had access before. Otherwise, you get the videos, and that's the charting course for you. And I think you're going to like it. You get two different types of, by the way, software. You can use a Java-based or a Windows-based for it. Now, I believe that what I try to do is give you a discipline for trading. And if you like what I do here, why not take a look at this? The normal cost, $169.95 for the holiday pricing, $99.95. It's for 30 days. Just about everybody gets through the course within a much, much shorter period than that. Should you need extra time, we work with you on that too. So if you'd like to learn my method, it's right here, a simple way to do it. And then the beauty is in the mornings when I say do those morning videos, that's how you catch up with everything. I'm Ira Epstein. You have a good day, and I will talk to you all tomorrow. No, make that, I'm going to talk to you Tuesday, the holiday. Forgot about it.